Hey, everybody. Welcome to the podcast. Thanks for joining me. Appreciate it. Well, the stock market started off the month of August on an up note. The Dow Jones kind of gapped up at the open today and really never gave it back. The Dow Jones finished up on the day of almost 130 points to 15,628. The S&P was up 21. NASDAQ was up 49, all somewhere between 1.2%, and the small and mid-cap stocks, especially mid-caps, up 2% today. And it really started last night. We got some conflicting data out of China. You know, China's been having some weaker numbers as of late, and in fact, their growth rate has continued to slow the last several months in a row. And their manufacturing data came out. One report came out better than expected, and one came out worse than expected. But the market took the good one and ran with it, and some better data out of the UK as well. And then we had a little bit of a beat this morning on some of our data also. So combine all that together, and stocks were green pretty much around the world. And we'll get back to the S&P 500 in just a minute. Treasury rates, you can see here, they had broken out of this little channel here, and looked like maybe they were going to start to roll over. And lo and behold, they are now testing the old highs from July 8th. So almost a month ago, we've been kind of moving sideways. And we're at a really key inflection point, not only for interest rates, but for the stock market as a whole. And the reason why is because tomorrow we're going to get our jobs number, BLS number. And right now it looks like the estimate is for somewhere around, I think 185,000 is the actual number from most of the economists. So some people, of course, want to see something with a 2 in front of it. They want to get 200,000. Interesting, though, if you look at who does these surveys, ADP does it, which we got that earlier. Then we have the official numbers. Kind of laugh because they're government numbers. How official can they be? But we got the official numbers. And then we also have Trim Tabs. And Trim Tabs is calling for something like 25 or 28,000 jobs to be created last month. So if that number was true, boy, it would be interesting to see. You'd see interest rates plummet, and you'd see the stock market probably sell off considerably. So if we get a number that's somewhere 150, 180, 200,000, I think this just continues. I don't know if interest rates will make a big move one way or the other if that number comes in, but certainly if it comes in much hotter than expected, you would expect this trend to continue where interest-sensitive things sell off and stocks go up. I don't think the market wants to see necessarily a 300,000 job print, but something that's strong. I think we are seeing, some of this good news. Stock market likes that, and for those of you that are new, you may say, well, why wouldn't the stock market ever not like good news? Well, remember, sometimes what happens, because people are addicted to the Fed and their actions, is when the data comes out too good, that means they're not going to be as accommodative. They're gonna keep interest rates a little higher, and but what's happening now is the Fed's done what they're going to do. They've printed all this money. We've got the quantitative easing version 3 in place, and so now the Fed's told us they're going to start dialing that back at some point, and interest rates have risen accordingly, and the stock market is rising on any bit of good news. So it's getting back to more of a normal, and that's what you would want. You want the Fed out of the way, earnings to come in better than expected, profits to be good, and the economy to grow. Unfortunately, I think what's happening is we're still seeing very, very lethargic economic numbers overall. I think when you look at GDP, and I put up a chart on the blog yesterday at karleggers.com. You can go check that out. But basically, if you take in consideration inflation and add it to GDP, we're at 2.9% right now. And we've never been at 2.9% and not been in a recession. So there's still people calling for a recession right now. And I'm not going to be one of those people that says we are or we aren't. It doesn't look like a recession, but it's interesting to say this would be the first time ever that we were at 2.9% and not in an inflation, not in a recession period. Have I been saying inflation? I meant in recession. But anyways, that we've not been in a recession. So, there's still a very fragile economy, I think, but certainly it's moving at a pace that, can it start to reaccelerate or not? And a lot of people believe the second half of the year we will start to see that. It's too early to tell that, but certainly the bond market is pricing that in, and the stock market is pricing that in. But if you look over the last 12 months, what's contributed to stock market gains, Dividends have been a very small part, and so has earnings growth. It's all been multiple expansion. What that means is people are paying more for the same amount of profits. So if the market had a 13 PE, now it's got a 16 PE, it's because the earnings didn't go up as fast as the market did. And that's really what's happening, as the market's getting more expensive because the earnings, have been mediocre. And we know the revenue, the top line from these companies has really been mediocre. But let's get to the stock market for a minute here. So tomorrow's going to be an important inflection point. On the podcast last time, I talked about the fact that I've been buying some stocks. We've been buying some companies that do a lot of infrastructure in Mexico and some kind of rail cars and things of that nature. We've been buying Starbucks. We bought that I think we bought it pre-earnings. And, of course, they had that gap up. We actually bought it the day before earnings because we felt like it was a good time here at that 50-day moving average. We bought this in our aggressive portfolio, our aggressive trading portfolio. And you can see it popped up, and it's been doing well ever since. So we've been buying stocks like that. At the same time, in our aggressive portfolio, we also took a short position, not a double or anything like that, but we shorted the S&P, figuring that we were at a point where it could roll over here and start to head back down. And we got that down 150-point day. If you recall, that was a few days ago. I guess that was Wednesday or Thursday last week. And then it reversed and actually finished flat on the day. And the market's been in a really tight range the last 10 trading sessions or so. And so now we're breaking out. So if we get a number that the market likes tomorrow and it confirms that, it stays above that, then I will cover my short. I had a very tight stop on it. We'll take a 2% loss or something like that, nothing major on that. But it was kind of an insurance policy. But it was kind of a pairs trade because we've been buying stocks in addition to, we've been buying stocks that we like in addition to shorting the S&P on that trading account. And so we've liked that combination. But certainly if the market gets out of this range, which it certainly looks like it's doing right now, then that number comes in okay tomorrow and the market likes it and it kind of holds those gains, we would cover that short pretty quickly. We did buy some healthcare today, and we've been also on these aggressive accounts, been buying a company that does a lot of web presence for online reservations of travel reservations and so forth. So we've been doing a lot of stuff like that, not really staying in one sector specifically, but trying to broaden out. And again, trying to just participate in the market. We are, today was a really interesting day because if you looked at the advanced decline line, and I mentioned this on Twitter all throughout the day, and if you want to follow me on Twitter, you can. It's the handle's at Karl Eggers. But what was interesting was the stock market, that the market finished pretty much at the high of the day, almost, and yet the advanced decline line finished at the low of the day. So you had this kind of, if you were to overlay the two, you'd have kind of an X, where the stock market was running up all day. And in fact, I'll show you the 5-minute picture here. And the stock market was pretty much running up all day. Tried to sell off at the end of the day, but couldn't. And the advanced decline line was it started out high and it just was going down, 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 and it finished with like plus 700 and some odd advancing stocks. And earlier in the day it was about 1,800. So it was really interesting to watch that. I think some of that is on the New York Stock Exchange. There's a lot of companies or things traded that aren't just operating companies. They're closed-end bond funds. They're REITs. Those types of things may have been positive again today and then turned around negative. So they contributed to some of that. But you did see some type of deterioration as the day went on. It also, wasn't a 90% up day or anything like that, but it was a healthy day. It was just interesting to watch how it kind of deteriorated as the day went on. So again, looking at the S&P, we're clearly breaking out here, and if we get a really horrible number, which I don't know what that means, right? If it's a really weak number or a really strong number, perhaps the market sells off. I don't know. But as long as we stay above here, we've gotten back in this channel that we had been in, and it was really important from a technical perspective. We broke out of it. It was important to get back in, which we did, and stay in, and now we have. The next thing is, it was kind of stuck here at this, we'll call it 1680, 1690 level, and now it's broken out. So it looks like we're ready to take off to another level, again, barring any major catastrophe on the economic front. Tomorrow's a busy day. We're going to start off with the Eurozone PPI, which is an inflation number for June. Of course, we're getting our payroll number in the morning, which is going to be a big market mover. Income and spending, we got factory orders. More earnings are going to be coming out. One of the Fed presidents going to be speaking tomorrow. Bullard, he's going to be speaking, and then tomorrow night after the market closes, we're going to get a China is going to have their non-manufacturing PMI. We got the manufacturing one last night. We're getting the non-manufacturing one tomorrow. So a whole bunch of stuff could move the market tomorrow. And, you know, I've got some short-term concerns for this market. There's no question about it. But just like all the other short-term concerns this, this year, the market has simply, or investors simply ignored it. And while we've had some times where the market's kind of sold off a little bit, for example, here and here and here, and this was a bigger one, about 6%, we really haven't had, the big downdrafts or the real big volatility. This has been an unusually quiet, non-volatile year. And so while I've got a lot of short-term concerns right now, they may not impact the market because so far they haven't in the past. Now I'll run you through a couple of short-term concerns that we're seeing. Obviously, as I mentioned, the quality of earnings for a lot of these S&P companies, a lot of companies overseas were affected by higher rates and currencies and all these different things. So their top line, their revenue hasn't been that impressive. They've been manufacturing earnings. So a lot of companies have beat their earnings, but not on their revenue. So that's always a concern. Also, we've seen the intensity the intensity for stock gains has kind of diminished in recent days, notwithstanding today, which was a pretty good day overall. But we've kind of been seeing some lackluster demand in the last couple of weeks. The other thing is the market's going to try to digest, who's going to be the next Fed president. It's going to be Janet Yellen, Larry Summers, a new name. Cohn was dropped in the bucket yesterday. So now we've got three people, and the market will react differently depending on who that person is. And that we may not know that for another couple of months, maybe even 3 months. Also, what we're seeing is a lot of flows into stock mutual funds and ETFs. And that tends to be a contrarian indicator when you see that type of money going in. At the same time, you're seeing money really coming out on the institutional side. So institutions are starting to lighten up considerably. Meanwhile, retail investors are piling in. And obviously, it was the right move today, but that can be a longer-term contrarian indicator. And then, of course, we've got Obamacare and the budget debate heating up and sequestration and all that stuff that was kind of put on the back burner, January 1. Here we are again, and it's starting to maybe rear its ugly head in the next couple months. And we do have August and September tend to be months that are, if you put those 2 months together, in the last 20 years, those are the weakest 2 months combined of the season, of the year, is August and September combined. So all those things are negatives. But again, those are all short-term concerns, I think, and we would still be using any weakness, short-term weakness, as a buying opportunity. Because in the bigger picture, overall, when you look at the demand for stocks versus the supply, it's still overwhelming. Demand is beating out supply. So it's just a matter of averaging in over time. And if you're fully invested, taking profits during certain times of the exuberation, or rotating out of areas that are showing some weakness and maybe taking advantage of some things that have sold off, or staying in some strong areas, but just maneuvering around. And so, again, it's about continuing to get invested, continuing to buy those dips, because overall, like I said, it is a market right now where demand is certainly outpacing supply. And there's still a rotation going on from bonds to stocks, and that's just happening right now. So you're getting the ultimate return chasing, where people are getting scared out of bonds, and they're taking that money from the mutual fund place and buying the mutual fund stock fund as opposed to the bond fund. So there's a lot of things. If you do own some, make sure you're hedged in some way. And we own some funds that do have a negative duration, meaning they actually go up on days where interest rates go up, because they have that ability based on what the portfolio can hold. So make sure that you have something like that in the portfolio if you're going to hold that type of stuff. Let's touch on Apple real quick. Still a holding of mine. We've been talking about that for a long time, and the fact that it does look like it's basing and bottoming here, and we've been moving sideways. And we pointed out just the fact that you look at some of these moving averages, which were going down, and now they're moving sideways. So on a longer picture, it's smoothing out. Even the bears are starting to talk positively about it. I think it can run up another $10 or so until we get to this area of resistance. And so what you're going to see is perhaps the 200-day moving average, which is going to be coming down and sloping down, continuing obviously, and we could be running into this top here, which is this area right here has been the resistance. So we could see that and see it roll over and perhaps come back in. And if you don't own it, maybe that's a good time to get in at that point, and then we could see it take off. Obviously, it could burst on through as well. But regardless, those are short-term trading ideas. But just from a fundamental standpoint, I think that this company, and we've talked about it before, and I won't spend a lot of time on it, but this company is turning into an Exxon, a Coke, a Procter & Gamble. It's a company that it's a different type of, it's going to attract a different type of investor over the years. You know, they've got almost a 3% dividend yield, which they could easily go up to 4 or 5. They've got a PE of 11. You know, it's just what's concerning people still is that you've got a hardware company that has huge margins. They make a lot of money off their hardware, and usually those things compress over time. Hardware companies will tend to compress over time, and they don't make as much money. So it's about the next product always. And I've said that before. For this company to really turn around and take off again, they're going to have to come up with a wow product, and they may do that pretty soon. But for the time being, looking across the spectrum, what stocks are just cheap and so forth, Apple still, to me, looks like a core holding. Let's touch on gold real quick here. Gold has failed at the 50-day moving average, and we did a couple of charts on it on the blog last week, talking about that. You know, we put a couple of question marks. Is it going to break through this? This has been obviously a line in the sand. Is it going to break on through above the 50-day moving average and take off, or is it going to fail and head back down? And so far, it's failing. I mean, you can see, I'll zoom in here, but that blue line is the 50-day moving average, and it's not getting beaten up, but it's really trickling down. It was down about 1% today, but it's riding that thing down. So a move above that, then of course you are talking about coming up in the 140, 145 range. But for now, it's just another failed attempt at this point. So again, there are stocks that are making big moves in the gold area, and the stocks are, you know, some of them are very undervalued, and it may be a great contrarian trade. But overall right now, there's no sense in piling into gold and trying to pick the bottom when there are too many other things working right now. Okay, that's going to wrap it up for today. Thanks for joining me. Appreciate it. Have a wonderful evening.